Hey everyone. Today we're going to crush out a question that got sent to me of just where the heck are we? Are we in a bear market? Are we in a bull market? Where are we? Because I know there's a lot of confusion out there and the news articles are going nuts. And is it an AI bull market? Is it a bear market? Is the economy slowing down? All that kind of stuff. So we're just going to try to cut through it all, throw the data at it just to kind of see where we are and overlay the general macro principles of what creates a recession and what creates a bull market. And let's just see if macroeconomically, are we in a bull market or a bear market? So let's dive right into it. First off, let's just go through what the heck is a business cycle and why does it matter for recessions and depressions. In the beginning, real economic growth is here, right? And as real economic growth kind of shows up, right? It's growing. Eventually, that real economic growth turns into typically too much inflation. Too much money is being created. That's going through the fractional reserve banking system. Talk about that another day. Anyways, that goes into this peak GDP, peak inflation. Everything's too high. Our central bank comes in and typically tightens things down, and boom, we go into a recession slash depression. Well, then typically disinflation or deflation kind of kicks in. The economics kind of start hurting, and then typically we get some sort of monetary expansion. Now, there's a few things that the Federal Reserve is going to do in the bottom here, or not even necessarily in the bottom, but as it's falling to try to make the recession not as bad or as painful as it would be without some of their tools. Really, what it is it's a deleveraging in the financial system. And as that deleveraging kicks in, typically assets start to have troubles and things like that. And so the Federal Reserve kind of jumps in here and we'll pump it up here and let's fix it here and let's kind of support it a little bit. So that way it's not just a falling brick that turns into a crash like 2008. And it's more of like a slow, methodical kind of rolling over, like a rolling recession. And that's typically an easier recession to deal with. And that's really what we're getting this time around. So let's kind of dig into what the Fed's been doing, where are we at in the cycle, the tools that they're using, and if we can determine kind of where we are. Because the bottom looks very different than the middle, and the peak looks very different than the bottom, right? So we'll talk about what actually creates the bottom and how we know that we're kind of in the middle of things, right? Okay, so first we got to talk about what the heck is the Fed doing right now, right? Well, the Fed right now is stopping our interest rate hikes, right? So that's one lever that they have for the monetary tightening that's stopping inflation, right? So that's interest rates. Another one that they have is their balance sheet. They buy financial assets, and that creates asset inflation and supports the financial system. And the theory is that it would also support the economy. So right now they are still tightening their balance sheet or reducing their balance sheet, which is a tightening mechanism. They are holding interest rates high or higher than what the yield curve would request from them. We'll talk about that in just a second. So they are still in their tightening mode. They are trying to tighten the economy down, right? That is a very big difference from what will happen in the bottom. So we'll talk about that. So this is just where we are right now. Inflation in black back here is falling, but still at about a 3.2% year over year. That's still a little high for the Fed, but it's coming down very aggressively. And we might actually even get some deflation here soon. More on that another time. So let's go back to 2008, and this might just give us a little bit of a better idea what the bottom looks like. All right, so the bottom in an economy when we're turning around and we're going into a full-on bull market, right? Typically, interest rates are pushing down and they are stimulating because we have some sort of disinflation or deflation that's kind of going down a little too far and they're trying to spur it back. And there's a little bit of momentum that kind of comes behind that. Then they end up, in the case of 2008, they ended up buying financial assets. So they grew their balance sheet and inflation is coming down very aggressively and is even starting to kind of roll over or come out of its low, right? That is when it's re-accelerating to the upside. That's typically hands down, boom, we are now in a monetary expansion stage. And then eventually we'll get real economic growth, which comes after the monetary expansion. So right now we are tightening, 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 kind of holding steady, right? Everything's tightening and inflation is dropping. So just by all of that, right? Just by that, kind of blueprint here, I would say that we're most likely before the recession or in the beginnings of the recession. This is kind of our cycle right now. We can look at 2000.com, which is kind of the same way. So you have this rising of interest rates. We stall out. Inflation starts to roll over, which it is right now, and then the interest rates start to come down. Check us out at etradingedge.com. And until next time, adapt to the market.